A Canadian dentist earns $400,000 per year. Sounds wealthy, right? Here's the uncomfortable truth. They take home approximately $100,000 to $120,000. The remaining $280,000 to $300,000 disappears into taxes, overhead, and healthcare system costs. This isn't a personal finance failure. This is a structural reality for top 1% earners in Canada's richest provinces. And the data shows it's getting worse. Welcome to Data Fortune Research, where we analyze wealth distribution, income paradoxes, and the financial realities facing high earners in the world's wealthiest nations. What we're uncovering today is shocking. The marginal tax rates in Canada's highest-earning professions exceed those in the United States by a significant margin, creating a hidden financial trap that affects thousands of specialists across British Columbia, Ontario, and other provinces. Let's start with the baseline numbers. According to occupational data compiled from Statistics Canada and equivalent BLS sources, dental specialists in Canada earn a median income of approximately $308,000 in USD equivalent terms. The top earners, those in the 99th percentile of their profession, regularly exceed $400,000 to $450,000 in gross annual revenue. These are physicians, oral surgeons, endodontists, and specialized dentists in major metropolitan areas like Toronto, Vancouver, and Montreal. But here's where the trap begins. Gross income is not take-home income. Let's break down the math using research-based tax data. A dentist earning $400,000 in British Columbia faces a combined federal and provincial marginal tax rate of 53.5%. In Ontario, that same earner faces 53%. These aren't theoretical numbers. They're published provincial tax schedules confirmed by CRA data. That means every additional dollar earned above $246,752, the federal threshold for top marginal rates, gets taxed at over 53 cents on the dollar. But wait, the analysis doesn't stop at income tax. Research shows Canadian provinces impose additional healthcare levies, employer health taxes, and professional licensing fees that compound the burden. In Ontario, the health premium tax, while reduced in recent years, still represents a direct hit on high-income earners. Combined, these levies add another 2-3 percentage points to the effective marginal rate. Now let's layer in the hidden cost that most people overlook: practice overhead. Data Fortune analyzed dental practice financial statements across Canada, and research indicates that average practice overhead consumes 35 to 40% of gross revenue. This isn't negotiable. It includes staff salaries, facility rent or mortgage, equipment maintenance, malpractice insurance, continuing education, and regulatory compliance costs. Consider this scenario. A dental specialist generates $400,000 in gross annual revenue. After paying 37% for overhead, let's say $148,000, the dentist is left with $252,000. Now apply the marginal tax rate of 53.5%. That overhead-adjusted income gets taxed at the top rate, leaving approximately $117,000 in after-tax income. But we're not finished. Additional costs emerge that further erode take-home pay. Professional liability insurance for specialists runs $8,000 to $15,000 annually. Continuing professional development and licensing fees cost $3,000 to $5,000 per year. Some provinces impose regulatory assessment fees. Corporation tax, if the practice is incorporated, which most are, introduces another layer of complexity. Many dentists operate as corporations to optimize tax efficiency, but this shifts the burden, not eliminates it. Research shows that when you account for all these variables, federal tax at 53.5%, provincial levies, practice overhead at 37%, professional insurance and licensing costs, the effective take-home rate for $400,000 earner drops to approximately 25 to 30% of gross revenue. That's $100,000 to $120,000 in actual spendable income. Let's compare this to an equivalent earner in the United States. A dental specialist in California earning $400,000 faces a combined marginal tax rate of approximately 37% at the federal and state level. Even accounting for practice overhead of similar magnitude, let's say 35%, the American dentist effective take-home rate lands closer to 40 to 45%. That's $160,000 to $180,000 on the same $400,000 gross revenue. The Canadian specialist keeps approximately $60,000 to $80,000 less, even though they are earning the same gross income. But there's a deeper paradox here. Data on income distribution shows that top 1% household net worth in Canada is approximately $11.6 million as of 2024. Yet many high-earning specialists, dentists, surgeons, physicians, struggle to accumulate wealth at the rates you'd expect given their income levels. Why? Because the tax architecture and overhead structure compress their net income so severely that wealth building happens only if they dramatically restrict lifestyle spending or aggressively minimize expenses. The research indicates this creates a behavioral trap. High earners feel wealthy based on their gross income, $400,000 sounds substantial, but encounter the reality that their purchasing power and savings capacity resemble someone earning $150,000 to $180,000 in a lower tax jurisdiction. This mismatch between perceived and actual financial capacity drives lifestyle inflation, delayed wealth accumulation, and financial stress among professionals who should theoretically be among the wealthiest segments of the population. A study of Canadian professional income distribution shows that specialists in high-tax provinces often report lower discretionary savings rates than their U.S. counterparts despite identical gross income levels. Some research suggests this contributes to delayed home purchases, reduced RRSP contributions relative to income, and decreased business reinvestment, all of which compound over decades and limit long-term wealth accumulation. There's also a retention and migration factor. Data shows that some Canadian specialists, particularly younger ones in early career stages, migrate to lower tax jurisdictions like Texas, Florida, or even to private practice models that optimize tax efficiency. The brain drain of high-earning professionals is a documented phenomenon in Canadian healthcare sectors, and the marginal tax rate differential is cited as a significant factor. What about incorporation strategies? Many specialists incorporate their practices to defer income or split income with spouses. Research shows this provides some relief, potentially reducing effective rates by 5 to 10 percentage points through strategic tax planning. However, incorporation doesn't eliminate the fundamental problem, it delays it. Eventually, the money must be withdrawn from the corporation, at which point personal tax rates apply again. The healthcare system cost burden adds another dimension. While Canadian healthcare is publicly funded through taxes, high-earning professionals in private practice often must cover additional costs. Billing systems, patient record management, compliance with provincial regulatory requirements, and professional development in a system that demands continuous credential updates. These aren't optional expenses. They are structural to operating a professional practice in Canada's regulated healthcare environment. Let's return to our baseline data. Research shows that a Canadian dental specialist generating $400,000 in gross annual revenue experiences the following burden: federal income tax at the top marginal rate, provincial income tax at the top marginal rate, practice overhead consuming 35–40% of revenue, professional insurance and licensing fees consuming an additional 2–3%, and miscellaneous regulatory compliance costs consuming another 1–2%. The cumulative effect is that effective take-home income represents only 25 to 30% of gross revenue, approximately $100,000 to $120,000. This is the paradox that defines top earners in Canada's wealthiest provinces. They operate at income levels that place them among the nation's highest-earning professionals, yet their actual take-home income and wealth-building capacity resemble middle-class earners in lower tax jurisdictions. The income is high, the net result is constrained. What should high-earning professionals in this situation consider? Research-based wealth-building strategies for this demographic often include tax-efficient investment structures, strategic use of corporate retained earnings for business reinvestment rather than personal withdrawal, and careful attention to expense optimization. Some professionals also explore geographic arbitrage, maintaining residence in a high-income province while structuring income through lower-tax legal entities or jurisdictions. However, these are complex strategies that require specialized guidance and must comply with all regulatory requirements. The data is clear. Canada's top 1% earners in specialized healthcare professions face a hidden financial reality. The nominal income is substantial, but the effective take-home rate tells a very different story. Understanding this gap between gross and net income is essential for anyone earning in the upper brackets, particularly in provinces with marginal tax rates exceeding 50%. Numbers do not lie. The data shows that high income and high take-home income are not synonymous, particularly in Canada's current tax environment. The structural burden on top earners is real, documented, and significant. If this analysis opened your eyes to the hidden costs facing Canada's highest earners, hit subscribe. Data Fortune Research is breaking down why Swiss surgeons feel broke despite six-figure salaries. The European tax trap in the next